Hey everyone, as you know, I've partnered with Questrade all month with a special offer just for In the Money listeners. In this episode, we are talking all about commodities. And with gold near records, Questrade has a platform to help you execute on some of the ideas you might hear on this podcast. Starting in the first quarter of 2026, they will be launching Quest Metals. This is a cost-effective way to buy real gold. And for a limited time, you don't pay any trading fees. And after that, it goes up to just 25 basis points. Now, what do you get out of it? Trading real gold on a digital platform. You get secure storage of real gold at the Royal Canadian Mint. You can trade instantly with real-time pricing and competitive execution. And you don't need a mountain of cash. You can start with as little as $5 using fractional ownership and manage your gold alongside all your other Questrade investments. Use my special promo code INTHEMONEY, all one word, when you sign up for your first self-directed account, and you can get a $50 cash reward. Or you can open a Quest Wealth Portfolios account and you'll get your first $10,000 managed for free for 1 year. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Well, as we wind down 2025, you can't help but notice what a tremendous year it has been for commodity investors. The commodity index is sitting around a 2-year high, in part thanks to a historic run for gold. Gold is on pace for its best annual gain since 1979. What happens with commodities from here? And in general, how much of your portfolio should be in commodities? We put this all to Hussein Allidina, who is the head of commodities for TD Asset Management. As always, let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Hussein Allidina, thank you so much for joining me.
Thanks for having me.
We are going to talk about the world of commodities. Our audience loves to talk about commodities. So we're going to talk about the pure commodities, not the stocks on top of them, because you're the head of that division for TD Asset Management. But before we dive in to each of the specifics, I think it's important for people to understand the role of commodities in your portfolio. You know, I've been very open about the fact that I don't love it. I'm not, and mainly it's because I'm not good at it. I feel like I'm not good at it the way I'm better at tech stocks or consumer stocks that are more conceptually easy for me to understand. Talk to me about how you think about the role of commodities in a portfolio.
Sure. So maybe first, you said it, the derivative. We're talking about the derivative. And the derivative, the commodity derivative, is the same instrument that Air Canada uses to hedge their jet fuel exposure, or Suncor uses to hedge their crude production. The derivative itself has a low or negative correlation to the stuff that you already have in your portfolio. So institutional investors, pensions have historically added a commodity allocation to their asset mix, primarily because of the low correlation. It's going to zig when everything else zags historically. And I think the secondary motivation or benefit is that, unlike the commodity equities that you talk about, the commodity actually affords inflation protection. So I used to be at Teachers. They had a pretty meaningful allocation, and that allocation was driven by this idea of, we're going to be able to push out our efficient frontier by adding something uncorrelated that has positive expected return. But in addition to that, I'm going to be able to reduce my portfolio's exposure to inflation. Equities will perform negatively when we see inflation, as we saw in 21, 22. Fixed income obviously underperforms. So we're adding commodities because it pushes out the efficient frontier and it hedges inflation. If you took your portfolio and you ran a regression against inflation, it would have negative beta to inflation. You don't want to build a portfolio that has positive beta to inflation, but if you can bring in assets like commodities, like infra, like real estate that have that positive beta, you spend less time, I think, thinking about the negative impact of inflation on your asset mix.
Positive beta, meaning if we're in an inflationary environment, this asset class will do well.
Historically, in periods of inflation and inflation vol, assets like commodities that have that positive beta tend to perform.
So where are we? So let's first understand then, where are we in the inflationary environment? That's a big question for all central banks right now. It is the question if you're a stock investor, and sitting on a year of probably big gains in commodities for most of them in 2025. How do you see the inflation picture evolving from here?
Sure. So when I look at inflation over the course of the last 20 years, right into COVID, US inflation averaged 1.3%. That was the anomaly. If you look at a longer period of time, you go back 50 years, 100 years, on average, developed world inflation has averaged north of 2%. I'm not going to make a call that I think inflation is going to be 4, 5, 6, 7%. I don't think it's going to be that high, but I think the likelihood that we go back to the pre-COVID abnormal 1.3% is pretty low. And so if I put a portfolio construction hat on, I want to have exposure in my portfolio to things that are going to perform in all macro environments. I think you'd agree that the vol around growth and the vol around inflation are likely to be higher over the course of the next little while. And if we can't call it, and if we look at the guys who get paid to call it, the central bankers, they haven't been able to call it. That sort of underscores the desire to have this portfolio that is going to be more well diversified and has to have commodities for that reason.
Okay, so then what does a responsible allocation to commodities look like in a total portfolio?
Yeah, so it very much depends on your risk profile, where you are in your kind of maturity. If I look at where I used to be, Ontario Teachers, they have an allocation today of 13%. That is materially higher than most of the academic work, but that's because they're solving for both their inflation-linked liabilities as well as the asset side. If we look at the academic work on the optimal allocation of commodities, it's somewhere between 5 and 10%, and that's through the sort of asset-only lens. I'm thinking about how do I maximize the Sharpe on my portfolio through time. That's 5 to 10%. Now, I'm sure we'll talk about this, but I'll argue that probably where we are in the commodity cycle right now implies higher than average returns, which would imply a higher allocation than that 5 to 10%. But I think if you're not at 5%, that portfolio is going to underperform. If you look at a portfolio from a drawdown perspective, so you have a 60-40 portfolio, you look at the drawdowns that portfolio gives you, I contrast that to a portfolio that has a 10% allocation to commodities. So I've reduced my equity and fixed income exposure to make room for that 10% commodity allocation. That portfolio has shallower drawdowns 2/3 of the time. And the 1/3 of the time where it's hurt you to have that allocation is when commodities in the preceding period have gone up by over 100%. And that's fundamental. If prices go up 100%, you're going to eventually see a production response, and price should underperform, total return should underperform. It's additive to include commodities because it makes the path a lot better. I'm not going to argue that commodity returns will average through time higher than equity returns, right? You said something earlier about I don't like commodities. If it's purely from a return lens, then that makes total sense because through time, equity returns should average above commodity returns. But there are meaningful periods of time where commodities have to perform in an effort to get your companies, or at least the companies that you talk about, to put money in the ground. And then while we wait for that production to come to market, prices stay elevated to ration demand and continue to elicit that supply response.
Yeah, I guess that's why I've always avoided it, because I am more price.
Yep.
I'm younger, so I think about, well, I'm going to be in it for like 25, 30 years.
Yep.
And I know that commodities are cyclical, and I don't feel like I have an edge on calling whether we're in the cycle or not in these cycles. And so, like, let's put your portfolio construction views not aside, but we've
Sure.
received them now.
Yes.
So 5 to 10%, think about owning commodities. But you do also have to think about the cycle
Sure.
of commodities. And there can be very long periods of outperformance and very long periods of underperformance. And one of the things we've heard this year on the podcast from those that are invested in commodities is that we could be at the beginning of a period of very long outperformance.
Yeah.
That the moves we've seen this year can set the stage for a multi-year rally. What do you say to that?
So can I bore you a little bit with my kind of thoughts on the commodity cycle?
Yes.
So you said that there are periods of time where commodity prices or returns perform. There are periods of time where they don't. If you look at the commodity cycle and measure by price, so the benchmark of the strategy that I manage is the Bloomberg Commodity Index. If you measure the cycle using that benchmark or the GSCI or another index, roughly speaking, from peak to peak, or trough to trough, as measured by price, a cycle is 25 to 30 years. We spend roughly 2/3 of that exploiting the investment that we made in the investment phase. So 2/3 of the time, commodity returns tend to be challenged, not negative, but below the long-term average, because price is not incentivizing production, because we've that the investment phase has lent to that investment and that production. But for 1/3 of the time, price moves meaningfully higher. Let's go back to, 1999, 2000. China joins WTO, demand for commodities starts to increase. If I look the period prior to that, for the 20 years prior to that, we were exploiting the investment that we had made. You weren't born. The investment that we had made in the late 70s, early 80s. That was an investment cycle that lasted 8 to 10 years. We then exploited for 20 years. China joins WTO, emerging market demand grows, another investment phase that lasts 10 to 12 years. And I'd argue since 2010, 2011, we've been exploiting that investment. If the demand for commodities was not still growing, then that would be okay. But demand is still growing. We have not incented the supply side. So I think, to answer your question, I think we're in the early stages. And I say that because when we look at the companies that are producing these commodities, they're still giving capital back to shareholders via dividends, buybacks. They're not deploying capital in the ground, and yet the demand for commodities continues to grow.
That is a perfect summary of what's going on with these, whether it's gold, whether it's copper, whether it's oil. All of these companies are only being rewarded if they take the money and give it back to shareholders.
Yeah, and I think
not grow production.
And I think that's a mindset, right? Because we have this recency bias. Commodities have been a terrible investment. Commodity production has suffered. But when you look at the data, the demand for oil, coal, copper, corn, whatever it is at a record high. It continues to grow. The rate of growth is slowing. Mm-hmm. But again, when I'm building my commodity supply and demand balance, it's levels that matter. The level of supply relative to the level of demand. Let's take coal as an example. We said coal is dirty. We're not going to produce coal. Coal production started to decrease. Coal demand also decreased, but not as fast as supply. Even before Putin's invasion of Ukraine, coal prices were at nominal record highs, not because demand was at a record high, but because we had neglected the supply side. And we're seeing that happen across the commodity space today.
I think that coal is so interesting, where you have a narrative, like you said, dirty coal, green energy transition, and then, coal starts to do well. Certain companies start to do really well that are coal companies. Do you expect that to continue?
Yeah, I think so. Ultimately, look, I'd love for us to live in an environment where the energy that we consume is not dirty and is not contributing to greenhouse gas emissions, et cetera. But the reality is the bulk of the world's GDP is still driven by dirty energy. We've spent a tremendous amount of time and effort to build out renewable, but we're still consuming over 100 million barrels a day of oil. We're consuming record amounts of natural gas, and that is what drives economic growth. We have to address the supply side. The growth, if we pick on oil, the growth that we're seeing in oil supply today, outside of the growth in U.S. shale, is coming from projects that we funded in 2011, 2012, at the tail end of the last cycle. Canada's production growth is growing today because of the investments that we made 10 years ago. If we don't address the next 5, 10, 15 years, we have a gap and a problem.
Oil, though, let's get into oil. I know people are like, talk about the commodities. So let's talk about it. Oil, just can't get out of bed. Can't get above, I'm talking West Texas Intermediate.
Yep.
Can't get above $60 per barrel, even with demand at record highs. Demand is slowing, even with OPEC pulling back, even with geopolitical, the threat of geopolitical unrest and wherever you want to pick your point. But let's use Venezuela right now. Oil still sluggish.
Yeah, so I think balance is, if you look at the supply and demand, and I'm very fundamental in kind of the way that we approach the market is oversupplied. It's probably oversupplied in the tune of 2 to 3 million barrels a day. And Q1 of 2026 is going to see, on paper at least, an even larger oversupply. So I think oil continues to trade challenged, at least until kind of first half of next year. I think we could trade down into the low 50s, maybe something with a 4 handle. But ultimately, when we look at the forward balance, when you look at 2026, 2027, 2028, there isn't a meaningful amount of growth coming from Canada, Brazil, Guyana. Still see some growth, but it's questionable whether that keeps up with demand growth, which is 800 to 1 million barrels a day.
Did you say oil could trade with a 4 handle?
We might see something in the high 40s, yeah.
That's not good. If you're long oil.
It's not good in the short term, so I think you definitely want to be active with your exposure.
And that's just because of an oversupply situation?
Yeah, so OPEC has started to return barrels back to the market for the last 12 months. Demand growth has been relatively tepid, but definitely materially stronger than the IEA and others have been calling for. And we're going to see inventories build over the course of the next 6 months. Today, we're seeing material builds on the water. They haven't shown up on land yet. But I think when that starts to occur, you're going to see price come under pressure.
What about the threat of geopolitical disturbances? And talk about it like in the near term with respect to Venezuela and whether the U.S. moves on Venezuela in some way, which has the world's largest oil reserves, and through the lens of history, like how geopolitical, like oil is probably one of the most geopolitical things out there. So how do you see those shocks affecting the commodity more broadly?
So maybe the first thing, the last time you've been paid to trade like geopolitical supply disruption was the fall of Muammar Gaddafi in Libya, which was a long time ago. You've had the potential for disruption many times in the last several years. You've never seen production disrupted. So I think there's probably very little geopolitical risk premium built into price, and that likely makes sense given you haven't seen production disruption. If I look at OPEC spare capacity, the numbers are somewhere between 2 and 4 million barrels a day. I'm probably closer to 2 than the 4. If we were to see a meaningful disruption, we don't really have the cover to meet that. But I think the market has gotten very tired trying to play that narrative because you haven't been paid. You've burned premia, buying upside. But I think ultimately, Amber, we're looking at a market that's north of 100 million barrels a day, and we're taking comfort in the fact that we have maybe 2 to 3 million barrels a day of spare capacity. And that's because we haven't seen a disruption. If we were to see a disruption, Venezuela or otherwise, prices move meaningfully higher. That's not our base case, of course. We're not positioned for that. But ultimately, I think that risk is real if there is a supply disruption.
And then there's also like kind of the broader story around, energy transition plus energy demand coming from things like AI. How do you see that playing out maybe in the long term with respect to oil?
Yeah, so first, as it relates to oil, this idea that oil demand, and I think it's fading, but this idea that oil demand is on the precipice of peaking, I think is the furthest thing from reality. Economic growth drives energy demand, and oil is still extremely cheap, available, secure, storable, et cetera. The IEA has kind of backed up a little bit from this idea that oil demand is going to peak, and are now arguing that we may need to invest because of the length of time it takes to bring this supply to market. I think oil demand continues to grow for the next 5, 10, 15 years, so long as economic growth is still happening. Ultimately, though, we're seeing substitution into things that are bullish for other commodities like natural gas. I'm sure we'll talk about copper, aluminum. As we move away from liquid for energy to power, we need a tremendous amount of copper, ali to move that power. We can debate what the fuel source of that power generation might be: wind, solar, gas, nuclear, et cetera. But ultimately, I need a tremendous amount of metal to move that power.
You mentioned natural gas, and I think that's a commodity that a lot of people have been waiting to get out of bed, and it has. Winter is here. Yeah. Do you see natural gas moving beyond it? That is so cyclical, right? A cold winter, you get these big moves in natural gas. But then there's this other piece, and you hear companies talk about natural gas being really key to fueling all of these data centers that are being built. With both of those hats on, seasons and AI, what is your outlook for natural gas?
Yeah, so the near term, to your point, is going to be very much a function of what weather looks like. December looks like it's going to come in slightly warmer than normal. The market's rallied meaningfully, but in the last couple of days has come off on the idea that December isn't going to be that cold. ultimately the path of gas between now and the end of March is pretty much weather. I have no edge. I'm not going to call it. I think when I look medium term, definitely in the US, we're going to see a meaningful increase in gas for power generation. Estimates suggest that we're using about 1.8 Bs of gas today, and that number is probably going to grow to six or 7 Bs over the course of the next 5 to 7 years. We're also going to be exporting.
This is billion cubic feet.
Yes.
We're going to go from 1.8
to roughly 6.
6. That's
6
huge.
Yeah, and it's a market that's about 100 Bs a day. At the same time, we're going to see LNG grow from 13 today to 15, 16, 17. And that should be supportive for US natural gas, but it's definitely going to contribute to an increase in volatility for gas price. If I look at storage in the US, at peak, we can get to 4 TCF. So usually by the end of the summer, we're at 4 TCF. But my load in the trillion cubic feet, yeah. Trillion cubic feet. But my load in the winter is materially higher than it is in the summer. And the best I can start with is 4. I haven't added storage capacity. So tremendously higher vol over the course of the winter because there's a risk, obviously, that you run out because you're starting with 4 and your demand load is higher. I do think, though, that U.S. gas producers can respond. So I think north of $4 an MMBTU, we will see a production response. And I think ultimately the bullishness that you're seeing globally because of increased LNG is going to lift U.S. prices, North American prices, but I don't see convergence with the rest of the world. I think the rest of the world comes closer to the U.S. price. 4 is probably where we're at.
And you also have to think about demand destruction, right? The cure for high commodity prices is high commodity prices. And this is a commodity price that feeds into people's everyday expenses, like heating their homes. And so I think there's large questions about what AI is ultimately going to do to that pricing, right?
And you're already seeing, Amber, problems in parts of the U.S. where power prices have moved higher. One of my colleagues, her mom lives in Arizona. Her bill has gone through the roof. It's more than doubled over the course of the last year.
Because of data centers.
Because of, the increase in power pricing. It's really interesting. If I look at power demand in the U.S. for the 20 years into 2024, power demand in the U.S. was flat to down. So we didn't spend to build the grid. We didn't refurbish the grid. This is true in Canada as well. And now I've got power demand increasing, partially because I'm reshoring and because I've got all this AI sort of power demand. We have to spend on that power grid so that you can get the power when you need it. But I do think power prices are going to move higher because we're coming out of that exploitation phase. If I can go back to my commodity cycle, into an investment phase, I have to incent companies to deploy capital to build out this infrastructure.
So the concern, if you're an AI investor, is we're going to build and we're not going to get the return on investment. And so that's what a lot of tech investors spend time fretting about. How would that look in commodity land? In a scenario where you've built out expecting that we're going to need all this capacity, and let's just say we don't get that return. What does that look like?
Yeah, I think the constraint is going to be that we don't have enough of the commodity to facilitate the power demand that we need for. So I think the constraint is commodity-led, which limits the ability of potentially AI to grow the way that some forecasts have called for. But I think that there's enough demand coming from the AI sector together with the large infra programs that we're seeing globally, the fiscal spend on military, et cetera, that it really tightens the commodity balance. It would look different, Amber, if we were sitting in 2012 and we looked backwards and we saw commodity prices having increased by over 100%. I have discouraged commodity production in the last 10 years because of what price has done. And that's a normal part, again, very normal part of the commodity cycle. What's unique, though, today, I think, is capital is flowing into a space that is very commodity intensive, right? So if I go back to the late 90s, capital was flowing into Mozilla, pets.com, et cetera, not going into the commodity space, which was, again, the right thing. But that capital wasn't going into a space that was very commodity intensive. Today, I'm spending money in a space that's going to consume a lot of commodities. I'm not spending the money yet in the commodity upstream, which creates tighter balances in the future.
So we've heard, just to summarize so far, we've heard a case for owning the commodities because of its relationship to inflation, and then maybe inflation is going to be higher than it's been.
Inflation and what it does in your portfolio because it's negatively correlated.
Don't worry. Yes, all of that. And then long term thinking about AI, which commodities are exposed to AI, and you've also mentioned copper,
Yeah.
As part of that. It's come with its lots of volatility.
Yep.
But each time it gets back up off the mat and it goes a little bit higher than maybe some of its previous peaks. And maybe we're going to do that again this time around. How do you think about the path for copper ultimately?
So copper, if I think about like the 26 commodities that make up my benchmark, copper is kind of the worst offender from a supply inelasticity perspective. If you look, Amber, at the world's copper production growth today, all of the copper production growth is coming from 3 mines that started in 2012. Not all of the copper, but all of the growth in copper production. 3 mines that started in 2012 that were incented from the last investment cycle. Today, if we pool our capital and we try to find copper resource, we're lucky if we're going to be producing ingots in 8 to 10 years. So the cycle is really, really long. It's also very, very harder to ration copper demand because you spend as a percentage of your disposable income very little on copper relative to energy. So copper price can go materially higher before we stop consuming copper. And that's why I like copper on a sort of multi-year view more than kind of the other commodities, the most supply constrained and a very, very strong, robust demand story, not just because of AI. Obviously, AI plays a big role, but copper is necessary for, like energy, for economic growth.
So, all of this is right in front of us, and you see people willing to trade it, certainly in tech stocks. Why hasn't it shown up more materially?
Massive recency buy-ins. It's been so hard. Like the commodity space,
future looking, right?
So the commodity space definitely has been challenged. And I can put $100 into a copper name, or I can put $100 into the Mag 7, and they seem to be returning 10% a week. It's easier, right? I think ultimately, though, when you look at what makes the world work, we need these commodities. As the balance tightens, copper's trading just shy of 12,000 a ton today, right? Which is pretty close to the highs, and that is despite the fact that economic growth has been relatively lackluster.
I think you've brought up an interesting point about psychology, and because you've been close to this asset class for a while, you also know that flows can matter.
Yep.
And portfolio manager interest can matter.
Yep.
And it's when the generalist starts talking about these stocks and sectors that things can really start to get moving again. How would you characterize maybe the generalist attitude towards commodities right now, how it's evolved?
Yeah, so I'd say the inbound that we're getting is less about the micro commodity story and more about the portfolio construction that I don't think you want to talk about, but I think it's more about that. So we have a tremendous amount of inbound from institutions, from consultants who are like, hey, we're worried about our equity fixed income correlation, which tends to be positive when inflation is north of 2%. We've spent time moving into private equity, private credit, but the equity fixed income beta is the same. We need something different. We're not having conversations yet about the micro, which is very, very different. I'm going to date myself. It's very, very different than 2004, 2005, where people were justifying to their boards a commodity allocation because of the diversification and inflation, but it was FOMO. They wanted to own it because it was going up. That hasn't happened yet. I think the interest today is very much portfolio construction focused. We do get interest on, commodities like gold and silver, which are moving meaningfully, but generally, I don't think the consensus has woken up to the coming shortfall in commodity balances.
If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the stock replacement tool, and news and insights under the tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Okay, so this segues really nicely into gold, which has been, if you're a Canadian investor, you invest in the sector, what an absolute home run. I think the TSX materials sector will put up an annual gain in 2025. It's so funny, like we started this talking about inflation, and everybody says, oh, gold, you own it for inflation. No. That's not why we've been owning gold. Tell us why we've been owning gold.
So Gold is not an inflation hedge. Gold is a store of value. So 2021, 2022, we had a lot of inflation. Gold did not perform. Gold acts as a store of value. I think the reason why gold has done what it's done is largely a reflection of emerging market central bank buying. So if you look at central bank reserves globally, the EM has more reserves in aggregate, paper and gold, than the DM. Developed market central banks have roughly 60% weighted average allocation to gold. Canada has none, the UK has none, but Germany, Italy, the US, etc. If I take the average of reserves in the developed market, 60% of DM reserves are in gold. What's the number for the
Developed market
reserves? What's the number for emerging market central banks?
60% are developed market.
Yeah. I know you're interviewing me, but
no, I know. I love games. I love to consider. And China is buying, and China's emerging market.
Yep. India's buying.
But I bet, based on your question, it's still quite low.
10%.
I was going to say 10%.
It's 10% after the rally that we've seen, after the fact that these central banks since 2021 have been buying over 1,000 tons per year.
So what do you think that number can get to?
So I don't think it can get to 60% because we don't have enough gold. But I think the reason that we're still long gold and happy to be overweight is because the inertia is in that direction. If I'm the, Indonesian central bank governor, making this up, and I look at my reserves, today 90% of my reserves are sitting in fiat, in US dollars. In 2021, when the Taliban took Afghanistan back over, President Joe Biden confiscated Afghan reserves. He gave half of it to 9/11 victims, and he kept the other half for when there's an Afghan government that the U.S. likes. I'm being a bit facetious, but that was the story. Most people didn't recognize that or pay attention to that. But when they confiscated Russian reserves, all these emerging market central banks woke up to that. So this year we've talked about de-dollarization, inflation, whatever it may be. I think the driver of this demand and continued driver of this demand is the portfolio construction of the central banks who move away from holding 80, 90% of their reserves in paper that could be depreciating, but that could definitely be taken away at the whim of the US president. So ultimately that demand, I think, continues. And we see it when we talk to the physical desks who are active in the space. Definitely central banks, emerging market central banks are not buying gold aggressively when it's rallied 20%, but they have structured buying programs in place and they're still buying. And retail today doesn't own gold, very little gold as a percent. If you look at the ETF open interest, well below the 10, 15% that Ray Dalio has argued that investors, I don't think you should have 10, 15%, particularly if you're younger. But ultimately, most folks are at zero or close to zero. Some folks in Canada will own the commodity equity. They'll own the gold equity. From a portfolio construction point of view, that's very different because that equity, Barrick, Suncor, whatever it may be, has a higher correlation with the benchmark that it trades on than it does the commodity you're trying to get exposure to.
And oil is a great example of that, oil languishing. And you've got a number of these stocks like Suncor, Imperial that are doing really well. Okay, come hell or high water, you're going to make this a portfolio construction podcast. I can already tell, but I do want to bring up that point about the dollar, the US dollar. The point has been made when people look for these longer cycles in commodities is you also have to look at the cycle of the US dollar. And it's less of a de-dollarization, like maybe you could say that, but the US dollar also goes through its own phases. Long phases of appreciating and long phases of depreciating relative to a basket of other currencies. Is that supportive of your view going forward that commodities will outperform the fact that the dollar maybe is in a softer period?
Yeah, so I don't need the dollar to weaken for the commodity story to work. We've had extended periods of time through history where both the dollar and commodities have strengthened, but I do think that the weakness in the dollar, which is likely over the course of the next 5-7 years, given where we're starting from, is going to be a tailwind to the commodity space.
Back to gold. So you think that central bank buying in emerging markets is the key driver?
Yes.
Retail is a driver.
Absolutely.
How do you do price targets?
No, I don't have. When I was running research, I had to do that. Thankfully, I don't. But I will say that I think we probably see 5,000 before we see 2,000. And I might sound crazy, but I don't think it's crazy to to see a price higher than that as we go over the course of the next 3 to 5 years, simply because we don't have the gold, right? When we talk about the upstream, we haven't encouraged investment in the upstream. So there's not a tremendous amount of gold that's being produced. I mentioned that these emerging market central banks have been buying over 1,000 tons per annum in the last 3 years. We produce 2,500 tons a year. So 1,000 of 2,500 has been going into EM reserves, and retail hasn't bought gold. Right? There's a pretty pronounced inverse correlation between equity market performance and the demand for gold. If I buy gold today, I'm giving up, my opportunity cost is NVIDIA, which is going up, 10% a week. I think if equities exhibit any sort of anxiety or turbulence, you will see an increase in retail demand for gold.
Especially now that, people in the commodity space are pointing out that actually over the long term, gold has outperformed, owning just the S&P 500. In 2025, gold is up 53%. So you won't give me a price target, but talk to me about the pace of gains and whether this was a meaningful jump up this year.
Yeah.
Do you realistically expect that pace of gains to continue?
I would be very surprised. I hope so. I would be very surprised if we saw another 50% in 2026. I'd be worried actually if we did, because I think it says something about the health of the financial market. Earlier this year in the fund, we've been constructive gold since the fund launched in 2023. Earlier this year, we played it by buying call spreads. So we owned upside. And at the time, we had struck sort of 3,600, 4,000 calls. And it was a bit of a lottery ticket. We didn't pay much for that exposure. It obviously came to fruition. I don't think that we see another 50% next year, but I do think that the inertia is to the upside.
Can we talk about silver as well? Not second place. All of a sudden, it's just got a fire lit under it and surged to the upside. What drove that?
So silver does trade sort of with gold, but obviously is up 2x. Ultimately, if you look at what's happened to silver inventories in London, they've been drawn down. And a lot of this, like we've seen in copper, is concerns that the US would impose import tariffs, Section 232. So a lot of silver has moved from the rest of the world into the US. And it's sitting in the US because there's still low probability, but probability that there is tariffs imposed on the import of silver. So available inventories in London have drawn down very meaningfully. The silver market as well is in deficit. I'm going to sound like a broken record, but I haven't encouraged anyone to look for silver in the last 10 years. The demand for silver is more industrial than the demand for gold. So central banks are not buying silver. But as we see an uptick in solar activity, as we see an increase in the build out of these data centers, we're using silver in many different economic purposes, and that's contributing to tightening the balance as well.
Silver can be a dangerous little metal to trade. It can be a little bit of a heartbreaker. How do you think about responsibly allocating to silver, and do you think it's moved too far ahead of itself?
So we have exposure to silver in the fund, but our exposure is at benchmark weight. So we have no active position in silver right now. Your point, like the vol on silver is super high. We try to be sort of good stewards of the capital that we're entrusted to manage. We have played silver using options throughout the year, and that's added a little bit of value relative to benchmark. But I'd rather, my thesis is materially stronger on gold and this emerging market central bank demand for gold. So I'd rather deploy active risk there.
So you've been content to sit out the rally in silver.
I'm at benchmark exposure. So you buy the fund, I get you the silver that the benchmark has, but I'm not over or underweight.
Talk to me about that fund. So it's a like a commodities pool, the TD Alternatives commodities pool. And, looking at the benchmark is the Bloomberg Commodity Index.
Yep.
You track the index, but then there are periods where you kind of underperform marginally.
Yep.
What is that? How do you differ from that benchmark? Is it a call you're trying to make for the longer term that isn't being captured in sort of the monthly returns of the index?
So the first thing, so you invest in the fund, the first thing that my team will do is we go and replicate that benchmark. That's very different than buying a basket of 26 equities because we have to roll that exposure every month. Otherwise, we end up with live cattle delivery at 161 Bay and it's not good. So we're rolling that exposure every month. Now we take active risk in the fund. We're trying to add 50 to 100 basis points of alpha relative to the benchmark every year. And we're taking active bets. So today in the fund, we're overweight copper, we're underweight oil, We're small, overweight European natural gas. We're short grains. And where you see the out or underperformance, that's us getting the active call right or wrong. This year has been, I would argue, a little bit more challenging. We're on the right side of benchmark for sure. But it's been more challenging because the market has been driven more by macro, we think, right? The tariff uncertainty. The president has tweeted 4 times about soybeans in the last 6 weeks, like very specific tweets. Commodities are ultimately fundamental. We can deviate from the fundamentals for a short period of time. The macro can kind of have a bigger beta, but ultimately these are real commodities that are produced and consumed. So if the price is away from fundamental fair value, it ultimately will mean revert.
One thing we haven't talked about, which is obviously topical this week, is interest rates.
Yep.
And interest rates going lower in the US, but question marks around, well, what's going to happen next? And we know what US President Donald Trump would like to see happen. The data, you would hope, needs to be supportive of those future rate cuts. How do you think about the relationship between interest rates and commodities?
Yeah, so higher rates, this is a really good question. Higher rates, all else equal, increase your cost of capital, right? I argued that the level of inflation that we saw in the 20 years through COVID was abnormal. The level of rates as a result was abnormal. Rates were lower. Scott Besson has written about this at length. Rates were arguably lower than they should have been because of the financial repression, QE, et cetera, which allowed us to invest. You've talked about shale companies quite a bit. That's allowed us to invest at a very low cost of capital, and we had a larger supply response than we would have otherwise. Today, the cost of capital, even though rates are likely to move lower, is materially higher than it was in that 20-year period, which means that the price I need in order to make an investment is higher, all else equal. And now, rates coming down when inflation maybe is not entirely addressed is really interesting for my asset class because I have positive beta in my asset class to inflation, whereas others don't.
So maybe this low rate environment with inflation not being under control is good for commodities.
I don't know. Yeah. So I don't know where, if I think about Ray Dalio's sort of 4 quadrants, you've seen like the inflation growth. I don't know where I'm going to end up in those 4 quadrants. If I end up in the quadrant where inflation is elevated and growth is low, stagflation, which we haven't seen in our life. I was a baby. You didn't see it.
I've only seen a bull market, basically.
Right. And this is interesting, right? Because most portfolios today have been built in this sort of low growth, low inflation environment. That's optimal for the 20 years that we've been in. But is it optimal if we end up in an environment where inflation is less well behaved? I don't think so. And I think that's what retail's not there yet in mass. That's where the institutions are, I think, very, very focused. They're building portfolios that should do well in sort of all scenarios, will underperform, right? If I know with conviction which quadrant I'm going to be in, my asset mix is going to look very different than if I don't know, but I want to build something that's going to do relatively well in all environments.
One thing we haven't talked about, actually a few things, but like tariffs, and we talked about how maybe that had affected the silver market, but all this talk about inflation, AI is seen to be deflationary. Ultimately, how do you where are those things in your kind of top 10 list of things that you're thinking about? Are they still like not at the forefront of driving prices?
Yeah, so we try to be very, very micro. So if you visit the office, you're happy to come whenever you'd like. We spend a lot of time looking at like the supply and demand. We're trying to build, what does the corn supply and demand look like in 2025, 2026, 2027? I have a forward price that I can use and say, okay, if corn is trading at $4.50 in 2026, what does that mean for supply? What does that mean for demand? And we take a lot of our active risk based on that sort of micro. These larger themes of deglobalization, decarbonization, and digitalization are all very, very constructive for the commodity ultimately. Today, we're talking about natural gas. I'm only using 1.8 BCF a day of a market in the US that's 100 BCF a day to fire that power generation for AI. That number grows and grows meaningfully over the course of the next 5 to 10 years. But today, it's not there yet. Copper as well. We're going to use a lot of copper to build out the midstream power generation infrastructure. Not yet, right? So this is why we spend a lot of time looking at what's happening in China, the property sector. That is still the biggest driver of commodity demand is economic growth, general economic growth. But obviously we're focused on these themes And the one thing that we haven't talked about is this sort of military spending in Europe.
Well, let's bring it up now. But I just like, as you're saying that, it makes me think about, you know, back in the day and actually still now when people talk about Tesla, they talk about Tesla like they're pricing it off of like 2030,
Yep.
you know, on a PE multiple of 2030, 2035. Like they're willing to go there on products that aren't even commercial yet.
Yep.
And it's so clear that that's not what happens in commodities.
It can't, right? Because if I'm pricing this oil deficit that I expect in 2030, I'm going to lift the price of oil higher today. That's going to result in a bigger surplus today than would be otherwise. And this is the challenge, right? We can say that, you know, the copper balance on a 5-year forward or 10-year forward view looks awesome. I need to convince the company to deploy the capital, like hundreds of millions of dollars of capital that they're not going to see a return on for 8 years. This is why you get the cycle. This is why prices tend to overshoot in an effort to force your hand to deploy that capital.
Quick minutes before we get to your pro picks. What do you think of all this defense spending, which is a huge global phenomenon, and what it means for commodities?
Yeah, so I think deglobalization is going to encourage military spending sort of across the world. There's been a lot of focus, obviously, on Germany and Europe following Russia, Ukraine. Ultimately, the stuff is commodity intensive. And what's interesting is that we're financing it by devaluing the denominator. We're printing more money that we don't have to buy this sort of material that we haven't invested in on the upstream. I think the setup, I'm biased, but I think the setup is definitely very, very interesting for the asset class.
All right, let's find, then the asset class being
Commodities.
Yeah, I didn't know if you were talking about like aluminum in particular. Okay, let's get into your top ideas now. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first top idea is short soybeans. You referenced that Donald Trump has tweeted many times or posted on X now, many times about soybean prices of all things.
Yeah. Big driver of votes in the US, right? There's a lot of farmers in the Midwest, midterms coming up next year. China historically has been one of the largest importers of soybeans globally. If we go back 10 years, all their beans that were imported came from the US. Brazil and Argentina have been growing their bean production, and China has diversified meaningfully where they get beans from today. There's been a lot of, I think, non-commercial or speculative flow into the soybean market under the assumption that we're going to send 20 million tons of beans.
Because that's part of the trade deals.
And that's definitely something that President Trump talks about quite a bit. We don't think that the amount of beans that ultimately go to China is anywhere near what is being priced in the market. So tactically, this is a very sort of kind of, 2-month trade. We think beans do trade lower. Balances in the US are comfortable. Balances in China are comfortable. If you run like your stocks to use versus price, the price is probably too high in the tune of 8 to 10%. So we have like a short in beans in the fund today.
And it's probably a hard trade for a retail investor to execute, but just for perspective, soybeans have gone up from the August lows up about 13%. And so you're basically calling for some of that to come out.
Yeah, I wouldn't be surprised if we see beans like with like a sub 10 handle at some point over the course of the next 6 weeks.
A call that probably has broader interest among our viewers is your second idea, which is long oil. And again, all of these have time horizons. So your soy call is short term, 2 to 3 months, as you said. Your long oil call is over the next 6 to 12 months. And if you've been listening to the whole podcast, not just this Pro Pick segment, you'll have heard Hussein say, I think oil could drop down to a 4 handle. But you also are calling for long oil over 6 to 12 months. So walk me through that.
Yeah, so I hope that the short-term bearishness comes to fruition because I'd like to get long with that sort of low 50, high 40 handle. Balance is oversupplied. Today, our oversupply is 3 million barrels a day. We're building oil on water, record amounts of oil on water. Production is still growing. Demand is firm, but production is outpacing that. And that's particularly true in the first quarter of next year. So I think the low is probably sometime in the first half of next year. But Amber, I think that at some point in the middle of next year, we're going to start looking, the consensus will start looking at 27 balances, 28 balances. We don't have that supply growth that we've had in 25 and the first part of 26. And I can't bring oil supply online overnight. There's going to be, I think, renewed focus on OPEC spare capacity and the low level of spare capacity that is present there. And inventories, notwithstanding the fact that they're building, are still relatively tight. And I think this is why the market is like, we're looking at these sort of lofty projected balances, but are loath to sell it pretty aggressively. First, because it hasn't worked. For the last 16 months, guys have said, this wasn't our view, but guys were quite bearish oil. That didn't materialize. But I think that inventories are building today. You can see it on the water. You can see it by looking at freight rates. So ultimately, we like oil, but I think you got to wait, 3 to 6 months before the lows are in.
Well, then that begs the question of like, well, what's a good oil price for you? If you go down to 40 or even like top or early 50s, that's still, about $10 a barrel coming out of the price.
Yeah.
So then, going back up to 60 seems like a good day.
Yeah. And I think ultimately by the end of 26 into 27, we'll probably be trading in the high 70s, low 80s.
Okay.
I think the sort of replacement or long run marginal cost of production is somewhere north of 70, but we have to overshoot because I have to encourage the company not to buy back their stock and instead to deploy capital, right? We've seen some M&A, and that underscores how challenging it is to grow production. If I'm willing to buy you as opposed to going to grow greenfield production, I think that's a testament to how challenging it is to grow production. We haven't talked about this in the last 10, 15 years because we haven't tried to do it. Once we start doing it, the focus on, resource nationalism, the ability to grow production is going to come back to the fore, and I think that's ultimately constructive.
Longer term call is on copper, 5 to 7 years. And again, with that lens of you spend a lot of time in micro, and that's really what matters near term. But you think the story that everybody says about electrification and needing copper to build all these data centers, that is going to propel copper higher 5 to 7 years.
Yeah, and ultimately, like we're trying to move away from kind of conventional fuel towards power. So if I think about energy mix globally, 10 years from now, more of our energy is going to come from power than it is from oil, et cetera, coal. I have to move that power. I have not invested in the power stack in North America, in Europe, for the better part of the last 20 years. That requires a tremendous amount of copper, and copper takes forever. If I can find it, it takes forever to produce. And that's where the balance, if I look at copper inventories globally, they're extremely tight today. And there isn't a sort of meaningful copper project on the horizon. That's an issue.
Hussein, it's been an absolute pleasure. Maybe you've convinced me. I'm going to take a look at the portfolio.
I'll send you the ticker.
Thank you. That's Hussein Allidina joining us from TD Asset Management. Maybe those were my vitamins. We're going to go back to the candy on our next episode. We've got Malcolm White of BMO Global Asset Management talking tech stocks and media stocks and telecom. So if you've got a question on that, you can email us questions@inthemoneypod.com, and we'll see you on the next episode.